Okay, welcome back to volume 13. So I'm just going to go over the FMG fib and just the characteristics of the fib so you guys can understand it. So I'll go through piece by piece. So each level you'll understand the significance of it and why I use those levels and why I use those targets. So let's just relate it to price. So at first now, let's just find a nice example. Let's find a nice example of a nice clear ABC. Multiple examples in here, but yeah, let's go to this example here at 1.15. Was it? A nice one, yeah, right here. So we're gonna look at this nice, perfect example of the fib in play. So we'll start it from there. So what I do is with my fib, so you can see we've got this area of support here. Yeah. So this is essentially the most expensive that price is going to be. So that's your high. So that's where you're going to say, I'm not willing to see price go past that. And that's your absolute low. So that's the best area where you would like, that's the cheapest you can get price for. That's the most expensive you can get price for. So this is how I look at my fib. So I'm essentially looking at price to move lower. So I think I want price to move lower. This is the highest price is going to get. So I apply my fib from the swing high down to the swing low. So essentially all you're doing now is looking for price to retrace. So again, this is paying full price for the trade down here. So your bias is short. So if I'm selling down here, I'm leaving myself exposed to all of this price movement that can potentially happen. If price gets higher than this price at 1.15 right here, I'm no longer willing to hold a short bias, if that makes sense. So I'm not willing to sell at this price any higher than 1.16, say 1.15, 700. I'm no longer willing to sell. So just mark that out, 700. So I'm looking at price to go down. So I want to see price move lower. So when we now put our fib on, so let's start with 38.2. So that's a 38.2% rejection. So how I look at it is I want more of a sell. So I've seen the A to B. I'm anticipating now price is going to start to move higher. So this is 30% off. So if I sell at 30% off, in regards to me invalidating, so like you guys say, invalidation of my trade setup. So if I sell at 38.2, for me to no longer want to be a seller, price needs to go where? 115,700. So that's where I'll abandon my trade idea and just say I was wrong So that is 174 pips. So for me to make any sort of profit, my target would have to be double that, which is gonna be, so my target would have to be here, 374 pips. So now we bring in another fib, which is a 50%. So 50% is usually the mid-level, as it is obviously is 50% off. So it's the midway point. So this is 50% off. So in a trending market, you're more likely to see 38 and 50% off, as the market makers and people that run the market don't really want to give you a good opportunity to get back in the market at such a high price. So what you need to understand is price moving against your bias is a good thing. So I'm short biased euro dollar. So I want to see price move lower down into that range at 1.1. So essentially that's my target. I want to see price at 1.1. Yeah. So I now don't want to sell here. I want to sell the higher price get. So we got 50%. So let's have a look at 50. So if I sell at 50%, my entry point is 1.4283. My stop loss is still going to be the same. So now that offers me a 3-to-1. So this is an area that for me, you can start to look for trade positions. But how do we know what is a valid target? How do we know potentially what price can offer us? So where we see price may potentially reverse from, so if we say 50% is a standard pullback, it's a midpoint, more often than not 50% will be rejected in a trending market. So I know my first area where I'm looking to exit the market at minimum is around 1.14. So we'll do that in red so you just know. So that's my first area where I'm looking to exit the market. 1.14, let's say 1.450 just to make it round number, 1.450. So then we look again at our next fib. So the next fib levels, so I'll bring all three on at the same time. So for me, this is my area that I like. This is my 61.8% fib area, 61.8 to my 70.02. So me, this is the area where I like to look for shorts. So more often than not, I'll set a limit at 66, which is 14733. So that's where I'm looking to set my limit. My target is my stop loss is 115,700, and my take profit, as you know, is 1.10. So that offers me a 4.89 risk to reward. So that's my first reversal zone that I pay a lot of attention to. So it's a 60 to 70% discount. Then I've got my next level of discount which is the 78.6 to 82.887. So that's where, for me, that's where I'm looking at even more of a discount. So in that range there, I usually sell at 82.8, always kind of just in the middle. That's how I catch my wicks. So same target now, 15700. So stop loss 15700, and our target stays the same of 110. So now look at my risk to reward. So this is all trading is about. The higher price moves against your area of invalidation, because you hear a lot of people say, oh, I sold, for example, say they sold here, and then they say, and then price came right back and hit me break even, and it went my way. That's because you sold at a good place, but you didn't let the market now indicate we're in a bearish or in a bullish environment. So then I've got my absolute highest where I'd look for an entry, which is 93.5. So at 93.5, this is how I grow an account quickly, and there's a way to grow an account safely. So my target is still 1.1. My entry point is 1.15. My stop loss is 157. So look at the risk and reward. If price pulls all the way up to that entry point, I need to now risk 20 pips to make a possible 550 pips. That's a 28.3% gain on your account. That would be nearly 2 to 3 months worth of trading at 10%, 8 to 10% gains. So let's have a look at price. So let's take this fib level off. So let's at first just keep our 50% on. Yeah. And then let's let price move a little bit. So we get our rejection. Initially, we get our first 50% pullback. Let's let the next candle play. We've broken through that. So 50% now, that's not what our market deems as a decent reversal. But now in our next area, our 60 to 70% area, we spiked above. So let's put on our 74, which is obviously the sweet spot as well. So 74.4 is the fib level that seems to have given us the high. So on this occasion, we got a 74% discount. Let's see what price does from there. We started to retrace. So like I said to you guys now, I look for price to enter at 66. That's my average. So that's one. So just to put back on my fib, 147, 14733. Here, stop loss 115,700. And my take profit, my swing target. So this is where you need to understand now. Now that we know where our high is, we need to look for a realistic target to shave profit. So last time, like I said, market participants don't change. So last time we only saw price make it down to this area here. So now we can change this. So we saw price make it down there. So an extension or a copy of that on. So if we copy price from there to there, that's saying at minimum we'll get a 2.5. So at 2.5 now, I need to start assessing price. That's where maybe I shave a bit off. I start to move my stop into positive or start to trail my stop. So let's have a look at how price moves. So we sell off, we sell off, we sell off. We had a little bounce. We've now hit that area. So look, immediately as we hit 1.123, what does price do? Price now starts to reverse back up. So now let's take a look at our targets. So now I've got different targets: minus 0.27, minus 0.54, 0.81, and 1.08. So that's my reverse target. So that's just basic standard targets: 1, 2, 3, 4. It's just a, like I said, price moves in ranges. So it's just a range expansion of each level. So we see now on this occasion, we came just shy. So just shy of our target. We was around 26 pips away from our D1, D2, D3, and D4. So if I want to hold this trade as a position trade, I'll be looking for 1.1. So let's see what price does on the next occasion. So here we've got our fib. We look at 66%. So we can see 66%. We had a nice hit of 66. And on that occasion, we've now fulfilled our previous target and we've just come shy. So we just came shy of our next target. So you see the way price lacks that 66. So we've already gone over the next one. On the next occasion, euro dollar obviously pushes through and takes that high out, but does reverse. So the main thing of when using a fib is where to put your high and low. So a lot of times people struggle. I don't know where to put my fib. I don't know where to put my fib. So if you're looking at a monthly trade, you're then looking at euro dollar in this aspect. You're looking at euro dollar bullish. So you're saying we've rallied all the way from this low up into this high. So potentially our macro chart, we could be looking at further upside. Or you can be looking at, this is basically an investment where you're saying prices also come all the way up here, but are we likely to see euro dollar at 0.9? That's under parity. It's not really likely. So you're more looking at price to go up. So then all it's about is sticking to your chart, sticking to the most recent high and low. That structure indicates. So your most recent high would be here, your most recent low would be there. So you can see right now we're in that 66% rejection. But obviously on a monthly chart, you need a massive stop loss. When you zoom down into your weekly chart, as we've already gone over this, we've seen that break in structure. We've seen that break in structure, which lets us know we're now looking for euro to go higher. So that's your significant low. That's your significant high. And we're looking at euro to hit 1.12500. When you struggle to find a place to place your fib, all you need to do is zoom out. Zoom out, zoom out, zoom out. So within a move, like I said, there can be smaller moves inside a move. So this is your overall movement. You're looking for longs from 1.1 up to 1.25. So that's your bias is bullish. But now the market is trending bullish, and now you're looking for additional entries. So you can see here A, B, you reverse to 50%, target 1, target 2. Then all you're going to do now is move up where you reverse from up to where price reverses from on the other side. You're now moving up A, B, C. This time we had a 78% pullback. We've then gone up to hit target. So now we're moving it up again. So on the next occasion now, it would be A. If this is the B leg here, then we're looking for euro to either come down to, like we said, We've had our A leg, B, so it might be 38, it might be 50, it might be 66 where I like to get long from. It could even be 782 or even 93. But as long as it doesn't go below the low, probability is with you that price will retrace higher. And only thing that changes is your risk and reward. That's the only thing that changes is your risk and reward. The deeper the pullback, the better your risk and reward. So let me find an example of a very, say, deep pullback. Too deep. Just want to look at a deep pullback. So yeah, if we look at US dollar CAD here, so let me just take this off. So if we look at US dollar CAD on this occasion right here, so let's take off. Yeah, let's do it from here to. Oh, you know what? Yeah, this is a perfect example. This is a perfect example. So we look at US dollar CAD. So we look at US dollar CAD. So we know our high is here, and we're starting to potentially see our low is there. So we're looking at price to retrace. So we get our indication, price retraces back up, doesn't quite touch that. So 66%. So look at my trade now, 66%. I'm in the trade. My stop loss is above the high. My target, I would target say 1.3. Reason why I target 1.3 is because this for me now is a weekly trade. So then we look at how price plays, starts to drop, starts to drop, starts to drop. But understand characteristics of price. So we had a first initial rejection, but then what? Price still wants to move higher. This isn't a cause for concern. This isn't a panic. What you need to do is find a higher probability area. So in this instance, you can see CAD reverses around 61 to 82.8 is the highest probability area because we can see multiple rejections. So this is a natural part of trading that you need to understand. Price might go, price here went for me. From here, we would have been in nearly 100 pips to now we're in a drawdown of 39 pips. We continue to see what price does. Hits 82.8 and then we get a massive sell-off where we could have entered again. So like I say, draw our trend line there. Once we had price, once we see price break out, once you see price break out of here, or even if you want to be conservative and say here, or even if you really want to let price break out, you would be saying here. But either way, we've seen price break out. We've got again that previous support, that previous resistance, which is a bit messy because it's all the way in here. So that previous support resistance, price has broke out, retested, we could have sold again. And now we're looking at downside, which you see starts to get achieved. So we just went past target 1. So if you had your target looking at target 1, you would have hit it. So let me again even pause this so you can understand what I'm saying to you. Let me take this off. So now we had our high in place, which now made our high here. So this is our swing high. This is now our swing low. So that's what you need to understand. We get our level out, which now shows us CAD. That for me is CAD's bullish trend line. You also got here as well if you want to draw the upside one, but I just only really draw the line that I'm the bias that I'm looking at. So I'm looking at it to break down, so I only need the bottom one. So we see prices come right back up into where price doesn't happen by accident. Price came right back up into 87, just shy of 93. So think of that. Your highest probability area was 87 because it's right at the top of the range. So if you sold at 87, yeah, this is how you got to look at it. You sell at 87, your stop loss is 40 pips. Give it a bit of room. So let's have a look at price. Playing around, we got that break. So now look at your risk to reward is already 3.7. Prices continues to pull back up, forms that higher low. So that at this point now, this is the point that I stress to people. That's the point where now you can move your stop loss. Now you can move your stop loss. The reason why you can move your stop loss now is because price has formed a lower high, sorry. So now you can move your stop loss into break even, and you can also even move your stop loss into 38 pips profit. Then you're gonna let the trade play now. So you can let the trade play. That would have hit target. The next time you could have moved your stop loss would have been once price broke another area of support, failed to break through it. So now you've banked in nearly 126 pips. Price comes right back down to the low, where you'd probably shave off some of your position, and you've got this area of support here. So if price shouldn't break above there, so you could even lock in to nearly 183 pips and keep price going in your direction. So that's the way you need to think about the fib. Another example I'll give you here, just to make you understand, is we're in a bullish market. So first identify what trend you're in. So we're in a bullish market. So we have a clear swing low up to our high. So we're looking at the high right here. This occasion we got a 66% retracement, and we ended up almost going all the way up if you held that trade for a swing. But the next trade, the next pullback is where you can really grow your account. So if you've got the bulls, so look at this level here. That is your NAS. The reason why, that is your A, B, C. Your C turns to your A. So let me just obviously write it so you can see. So that's your initial A leg. So that's your swing low. So we're going bullish. So let's put bullish. That's your swing low, A. Up into your B is your swing high. Then you got your C leg. Now this is the point where it's tricky. Your C leg, so your C reversal, yeah, so I'll leave that there for now. Your C reversal, so I'm talking about this. And then you've got your D target, which obviously would be here because that's the level that closed out. So that's your D target, yeah, which is fine. So A, B, C, and then for me now, I could even say, yeah, just here could be your D anyway. So you got your A, you got your B, you got your C, you got your D target because price made a new high. So as long as price makes a new high, that's your D target. So now your C becomes your A, yeah? That now becomes your C, becomes your A. Your D becomes your B leg. So now you're looking at this, A, B. Again, so now this is your C leg. This now is your C leg reversal. That's now your C leg reversal. So look at the risk to reward you could have had. So if you understood the concept and you said, that's where I'm looking, first one will target here, then obviously your D target is, say, would be here. The D target one is here. So look at the risk and reward, just to show you what is possible. If you went long at 93.5, which obviously your trade setup is still valid, and that's what you need to understand. The closer price gets to your invalidation, so that is at entry point is at 55. Your stop loss needs to be 54,772. So your stop loss is 54,772. That's if you want to be very precise. That's right at the low. That's 22 pips. Me personally, I'd give it 30 pips. Just to be safe, just give it a little bit of room. Your risk to reward on this trade can end up going to 16 to 1, and that's if you give it room. If you do be conservative and you do say your stop level is 772, you're getting 21 to 1. So if you really look at the possibilities in Forex once you understand what you're doing. If you held this trade all the way up to currently where it is, you're running into 32% in one trade. So once you understand that, it's okay for price to come against you as long as you have a clear level of invalidation where you know price shouldn't come below this region, and that's where I'll abandon my idea. As long as you have that, the closer it gets to that area, the better the risk and reward, and that's where you should be looking to go long. You literally need 19 pips and you could have made 38 to 1. So that's the realism of this strategy once you have confidence in it and once you can assess the markets without fear. So I'm going to move into moving averages now. I'm going to move into moving averages now as a way to show you how you can increase the probability further of the turning points in the market.